Hello again and welcome. Thank you for joining us. This is Robert Schein, Managing Director, Partner of Blanke, Schein Wealth Management. Today is the 3rd of March of 2022, and a lot of headlines moving markets. We're going to pay attention to that, and we're going to discuss that right now. Thanks for watching. So markets moved big to the positive yesterday, all three indices. Major breadth, major upside, and it was a very good day in the markets. And the reason why that was is Federal Reserve Chairman provided guidance. He basically was testifying in front of Capitol Hill. And in his testimony, he basically said that in March, which is a few weeks away, and then the March meeting, he supports only a 25 basis point raise or rise in the Fed funds rate. Now, that's interesting because, and that is news breaking, it provides clarity and transparency, and that's what markets like. That's why markets go up as a result, because they don't like the uncertainty. So he took the uncertainty card off the table. That doesn't mean they're going to do it. It still has, the Federal Reserve has to have a committee and sort of have a positive sort of consensus view on that. Again, 3 weeks ago before Russia and Ukraine, there was a 50 basis points that was sort of baked in. It was like a better than 70% odds, and those odds have now diminished to zero. In fact, yesterday, I think that was the nail in the coffin, as Federal Reserve Chairman said that. Now, this morning, Jeremy Siegel was on CNBC. Now, Jeremy Siegel, if you don't know who he is, he wrote the Stocks for the Long Run, a great book a few decades back. He's one of those that professors, market enthusiast and economic sort of guru, if you will. I had the pleasure of seeing Jeremy Siegel in person when I was back there at Wharton Business School for my investment management consultant designation. And I will tell you, he's everything plus more. He's a great person to know. But Jeremy Siegel was on CNBC this morning basically saying that if the Federal Reserve only does 25 basis points right now, it would be a big policy mistake. That's what I put on the board right now. That's a quote from Jeremy Siegel real time earlier this morning on CNBC Squawk Box. Now, that being said, and the reason why he's saying that is he doesn't want the Fed to utilize the geopolitical tensions right now, and that's ultimately a distraction because you have to look at the U.S. economy. The consumer's strong. We have labor tight, a very tight labor market, which are all quality backdrops as to giving the Federal Reserve the opportunity to raise interest rates a little bit more aggressively. And I think that's what we should see. As a result, you're going to see financials. Two things up here. You're seeing sort of the financials take off. They're selling off the last few weeks, obviously, because of markets have been doing that. But if you think about, and we have a base case saying interest rates will be higher from where they are today to by the end of the year, financials will get a lift. And I put a sort of a double plus there because financials will still be in play. In fact, today, based upon their valuations and based upon the backdrop that we see, consumer loan demand increase and a few other factors, higher interest rates, banks make more money and they're more profitable when interest rates rise. That's why we have favorable sort of outlook for banks, and we've been very constructive on banks, even though if you look at banks right now, it's a good time to buy because of great valuations, right? So we want to hold our banks, and they do better when interest rates rise. Now, what also sort of has sort of this inverse relationship. Technology did better when Federal Reserve Chairman said, hey, listen, instead of 50 basis points, we're only going to do 25 basis points because technology is a long-dated asset class and it's a long-dated cash flow, if you will. So you have to take out the discount rate or the Fed funds rate in this case to when you actually model and evaluate sort of what fair market value for the corporation would be, sort of how you evaluate companies. So when you say the Federal Reserve is going to be more aggressive in their policy, meaning they're going to raise interest rates quicker and faster, technology doesn't do so well. But yesterday, again, he said he wasn't going to be so aggressive. He's going to be sort of moderate and keep a pace. So that's something where technology, again, still could be in play. We are still very constructive on technology, and there's a lot of great opportunities out there, both in the financials and the tech space. And we're working our way through it. I mean, we're seeing the S&P, the NASDAQ, and the Dow all create sort of constructive bottoming through this process right now. Obviously, we had a retest, and we're putting in market bottoms, we hope. We don't know where we go from here, but right now, on a day-to-day basis, we're getting closer to certainty with the Federal Reserve. We're getting closer to the reopening trade. Think about this. Business travel hasn't come back online yet. And I will tell you, the more and more we see like the State of the Union, everyone taking the masks off and people, I even have a local business owner. She said the day that the mask mandate here on El Paseo, here locally, she said her business was dead the day that the mask mandate in California was instituted. No traffic whatsoever. She had to suffer through the holidays. And yesterday we had a review and she was in my office and she said, Robert, when California lifted the outdoor mandate and the indoor mandate for at least adults, not kids in schools just yet, She said her business took off the exact same day. All of a sudden, consumers are starting to come out. So consumers are out again. They're following the guidelines, and now they're more and more going to start spending more and more money, and that's going to be good and healthy for the economy. Again, obviously, we have some geopolitical concerns in the short term, and that has implications for energy and oil. And I think that's where Jeremy Siegel comes back full circle right now and says, "Hey, wait a minute." Energy prices is going to take a bite out of the consumer's wallet, and that's negatively going to be affect. So we have to worry about inflation, and that's why he says inflation is sort of runaway. We should have the Fed be more aggressive than that. Now, my last thing is that the consumer is going to balk, right? If you have $5, we have more than $5 gas prices here in California. And we have higher prices everywhere. So, what the cure is for higher prices are higher prices. In fact, if we get CarMax just put out some data in Wall Street Journal yesterday, and they said basically that consumers are now not paying the 30 or 40% premium on used cars. So there is that consumers balking. And my last pun right there, or reference to baseball right there, is that the Major League Baseball just gave us a blow. And I think that's the worst news all week, is that they're going to take out the first two series and postpone that and kick back the start of the season right now, simply because the Major League Baseball Players Association and Major League Baseball owners essentially can't see eye to eye. So hopefully we have Major League Baseball get back to spring training and come to agreement. Hopefully we thoughts and prayers on this geopolitical crisis that we have. And in the meantime, we're keeping our eye on what markets are paying attention to. So we are too, and we're reporting that to you. So thanks for watching, and we'll see you again next time. Take care.